Welcome to the Opening Bell Report.
We are jumping straight into an analysis report on that massive 16% surge in SoundHound AI.
Yeah, huge move.
The report covers the technicals, the revenue, and of course, the cash burn risks. Let's get right to it.
This is a high-energy piece, lots of moving parts. I'm ready to see if it all holds together.
Okay, let's start with the first section. It's called the breakdown. And a key theme right away is trying to figure out who exactly is driving this rally.
Right, the participants.
The analysis very explicitly claims that the gap up and the sustained buying usually means institutions are stepping back in.
And it goes further than that, too.
It does. It says this wasn't, and I'm quoting here, retail traders on Reddit.
Okay, so that's a very confident assertion. And it provides a strong hook, right? The smart money is here.
Exactly.
But I do wonder, have we considered the standard of proof required to make that claim?
Okay.
We're looking at this through a logic and support lens. And the weakness here, I think, is that saying it's institutions and not retail, just based on a price gap.
And sustained buying.
And sustained buying, right. That's really just correlation. It's not causation. It's a bit of a leap for a serious analysis report.
So you're saying retail could also be behind that kind of move?
Absolutely. Retail can sustain buying pressure, especially on a name like SoundHound that already has, a history of going viral. So if we just assert it's institutions without hard data, we risk kind of losing a more sophisticated reader.
I see that. You want to validate the rally by saying the smart money is in, which is a great narrative.
For sure.
But you have to prove it. So how do we strengthen that? What specific evidence could we add to move this from just a hunch to a fact?
Well, we need to bring in some concrete volume analysis. My suggestion would be to, really strengthen the argument by using specific volume metrics that are characteristic of institutional buying.
Okay.
Institutions, they leave footprints, and those footprints are in the data, not just the shape of the candle on a chart.
Could you give a concrete example? What does that data actually look like in the text?
Yeah, absolutely. So instead of just saying institutions are stepping back in, the analysis could point to relative volume, RVL. If the report said something like, RVOL was 3.5 times the 10-day average, well, that implies a massive demand for liquidity that retail alone usually can't generate.
That's a much harder data point.
It is. And then you could look for block trades. Check dark pool data or time in sales for big, single prints. If you see 50,000, 100,000 shares hitting the tape at once,
that's a fund.
That's a fund taking a position. Exactly. You can contrast that with thousands of little 100-share orders, which would suggest retail is, driving the bus.
Yeah, that's a fantastic distinction. It changes the claim from, it feels like institutions do, the order flow confirms institutions.
Precisely. And one other angle is just timing. Retail volume often fades during the lunch hour, right?
Right, noon to 1 Eastern.
Whereas institutional algorithms, they tend to execute pretty steadily all day. So if the analysis noted, buying pressure persisted through the typical lunch hour lull, that's another much stronger piece of evidence.
And what about that agentic AI narrative that the report mentions?
That's the final piece. You have to connect it. It would be so much stronger if the analysis, showed whether that narrative has started appearing in actual institutional research notes.
Ah, so citing a specific bank that just upgraded the sector based on that idea.
Exactly. That proves the causation instead of just implying it.
That really ground all the excitement in hard data. Okay, moving on, let's look at the fundamentals section. So the material makes a pretty strong case for the valuation by saying, look, this is a hyper-growth company.
It is.
And it brings up the price-to-sales ratio, which is sitting around 22x. The analysis admits that's expensive, but then it justifies it.
How?
By comparing SoundHound to giants like Palantir or even NVIDIA. It says investors are willing to pay a premium for AI leadership.
Okay, on the surface that makes sense, right? It sets a benchmark for expensive but worth it.
Yeah.
But couldn't the evidence also, couldn't it support a different conclusion? I'm looking at this through the lens of significance and relevance.
Go on.
The weakness here is that comparing a small cap company that's burning cash directly to a massive, profitable titan like NVIDIA, it's a false equivalency.
A logical fallacy.
It is. NVIDIA defines its market and prints money. SoundHound is a challenger that's losing money. Comparing their multiples implies they have the same risk profile, and they don't.
It's like comparing a startup lemonade stand to Coca-Cola.
Exactly that. So you see the problem. It feels good to make the comparison, but it might be hiding the actual risk here.
So how do we fix that? How do we refine the context without totally losing that premium for AI argument?
I think the suggestion is to refine the valuation context by comparing it against a company's specific growth stage and, more importantly, its actual peers. We need to compare apples to fast-growing apples, not apples to, massive established orchards.
So what would a better comparison look like in the text?
Well, for a concrete example, you could still acknowledge the NVIDIA comparison, but then you immediately qualify it. Is still burning cash, which makes its premium inherently riskier.
That honesty builds trust.
It does. Or even better, compare that 22x multiple to other high-growth, unprofitable software companies. Look at other SaaS names growing at 50-60% that aren't profitable yet. That's the real peer group.
That aligns the reader's expectations so much better. It shows the analyst actually understands the whole ecosystem, not just the big headline names.
Precisely. And if we really want to get technical, which, this kind of audience appreciates, you could analyze the price to sales to growth ratio. The report says 67% revenue growth.
Right.
Well, does that mathematically justify a 22x multiple? Maybe it does. Maybe it's actually cheap relative to its growth. But just relying on this sort of NVIDIA halo effect, it's a weak link. It feels a bit like marketing, not analysis.
That is a crucial point, moving from marketing language to analytical language. Okay, let's shift to the reality check section.
The cash burn.
The cash burn. This part highlights a pretty striking metric. For every dollar they bring in, they are spending nearly $3.
Oof.
Yeah. And it notes a negative free cash flow of over $34 million. It's framed very explicitly as a red flag.
And it certainly is a red flag. But I have a question about how it fits into the overall story here.
Okay.
I'm looking at this through a structure and flow lens. The weakness is that this data is presented as this sort of isolated bad thing that's separate from the good thing in the fundamentals section.
So it's very binary. Growth is good, burn is bad.
Exactly. But in high-growth tech, the burn is often the fuel for the growth. What's missing is a synthesis of why the spend is so high. Is it bad waste or is it a good investment?
That is a fascinating way to put it. The current draft just kind of leaves it there as a threat, something that could derail the whole thing.
Right.
So the suggestion is to bridge that gap between fundamentals and the reality check. Frame the negative margins as the specific cost of getting that 67% growth.
Yes, integrate the two ideas. For a concrete example, you could connect that $3 spending figure directly to the massive backlog that's mentioned in the bull case.
Oh, okay.
Ask the question, is that capital being burned to build out server infrastructure to fulfill those big auto orders? If it is, that's bullish burn. That's CapEx for future revenue. But if it's all just sales and marketing with diminishing returns, that's bearish. The analysis needs to make that distinction.
So instead of just saying they spend too much, we analyze the efficiency of that spend.
It completely changes the tone from just being alarmist to being analytical.
Yes.
And on the dilution risk that's mentioned, let's make it actionable. Don't leave it as this vague boogeyman. Calculate a runway.
Based on the cash on hand.
Exactly. With a $34.7 million quarterly burn, how many quarters do they have left? The analysis could say, at this rate, they have 4 quarters of runway, making a capital raise likely in late 2025. That turns a generic warning into a specific timeline for the investor to watch.
It turns a stop sign into a roadmap. I like that.
That's the idea.
Okay, final section. Technical analysis and forecast. The report identifies resistance at $10 and then points to an analyst price target of $16.07.
Which is what, 87% upside from here?
Almost, yeah. Huge upside.
It is, but have we noticed the little jump in logic there? I'm looking at this through a clarity and precision lens.
Okay.
The weakness I see is a disconnect between the methodologies. It uses a psychological chart level for the first target, $10. That's valid TA.
Standard stuff.
But then it just switches to an external analyst rating for the second target, the 1607. It doesn't explain the technical path to get there. It feels disjointed. Why 16? Why not 14 or 20?
It does feel like we stepped off the chart and into someone else's research report without a transition.
Yeah.
The ambition of the target is great, but the path needs fixing. So the suggestion here is what? To harmonize the methodology?
Exactly. If you're using technical analysis, you need to identify the technical structure that points to $16.
Right.
The analyst needs to explain why 16 is a significant level technically. Is it a historical high, a Fibonacci extension? A concrete example would be to discuss the air pocket between 10 and 16.
The lack of resistance.
Right. If the chart shows volume gaps in that zone, you can argue once $10 clears, there is minimal volume resistance until 16, allowing for a rapid move. That connects the two numbers.
And what if they want to stick to a fundamental reason for 16?
Then explain the math behind the analyst target. Don't just appeal to authority. Explain that $16 assumes a 30x multiple on forward revenue, for example. And then connect the downside, the retest of $8.
Right.
Connect that back to the breakaway gap logic from earlier. Why does that gap have to hold for the $16 thesis to be valid? You need to weave the risk and the reward into one coherent story.
It seems like the common thread through all of this today is specificity.
I think so.
Whether it's volume or valuation or price targets, the analysis just needs to go one layer deeper.
It's the difference between the what and the why, isn't it? The report is excellent at reporting what is happening. The price is up, revenue is up, burn is high.
All true.
But to really elevate it, the analyst needs to explain why it all matters and how these things interact. Valuation isn't just about a number. It's about the cost of growth relative to actual peers. Cash burn isn't just a loss, it's an investment calculation.
And price targets aren't just wishes on a chart.
Exactly. They're structural levels derived from data.
That's a fantastic summary. So let's recap the main points for the update. First, move beyond just price action to prove institutional involvement.
Yep. Use RIVOL, use dark pool data, use something concrete.
Second, make those valuation comparisons more realistic. Comparing to NVIDIA is a shortcut. Use sector-specific peers with similar profiles.
Third, synthesize the cash burn. Don't just list it as a red flag. Contextualize it as the cost of growth and calculate the actual runway. Make the risk tangible.
And finally, align the logic behind the price targets. Show the path from $10 to $16, whether it's technical or fundamental. Don't just switch methodologies.
That's it.
To the listener who submitted this, you've captured the energy of this SOUND move perfectly. The excitement is absolutely there.
For sure. The topic is incredibly relevant.
And now it's just about adding that rigorous connective tissue that turns a great hype piece into a really serious financial analysis. We would love to see a revised version.
Absolutely. That agentic AI narrative is strong. You have a great handle on the pulse of the market. Just tighten up the evidence, and this will be a piece that doesn't just inform, it really educates.
That
Don't forget to like, share, and subscribe for more.